right, everyone. Very excited to share this episode with you. We are bringing Paul Merriman back on the show, and he has a new book called We're Talking Millions. I'm telling you, this will be a core book in the FI community. Not only does it present the building blocks, the replicable path to wealth, but I think even more than maybe what Paul has done in the past, which is one of the maybe the biggest stumbling blocks that people have had, is the simplification that's imbued in this that still encompasses the strategies that he laid out in the ultimate buy and hold that he started talking about 10, 15, 20 years ago. It's all here. It's all come together. There's a synthesis that's well defined. And this strategy is so popular with our community. This book makes it very easy to share it with others. I wanted just to say to our audience that two things. One, this conversation is just between me and Paul. Brad actually had to call out sick today last minute. So if you're wondering, where is Brad? He's not doing quite well. Keep him in your thoughts. He'll be back hopefully next week or maybe even this Friday. But the other thing I wanted to add is and it's important, this is not the first time that we've spoken with Paul Merriman. And I just laid that out. But the reason I say that is I think you need to listen to that first episode to truly appreciate what we're going to be talking about today. So Paul joined us. It was in 2019. He joined us in episode 130, and in that episode, he was introducing the ultimate buy and hold portfolio. And in that, the big takeaway, and we'll come back to it. We'll go back over a few of these ideas, but we obviously do a deep dive in that episode. Is that when we buy index funds and specifically cap weighted index funds, and we have one fund, or even when you're an individual investor, but you're just buying the companies that are doing really, really well, you're not as diversified as you think you are. And the academic papers show that the companies that you probably aren't owning enough of really are what carry a lot of the growth over extended periods of time. And there's ways that we call, we call these asset classes, and the two of them in particular that Paul's a fan of that he doesn't think gets enough attention are small cap and value. Now, we'll do a little definitions of terms here, but in other strategies, these are not given enough attention. So I'm going to bring Paul on right now, and we're going to pick up this conversation. We're going to talk about all of this, but I'm going to start with just kind of a devil's advocate controversial position in that if you have put a focus on investing in small cap and value over something like a cap weighted index fund, you have languished in your performance for now the last decade, maybe even slightly longer than that. So some of you that have already done this strategy say, well, that's what I've been doing, and it's hard to hold the faith. Does this really work? And so Paul, I would say to you, let's just put it right out there. I mean, this is the strategy, but this strategy for 12 years has underperformed a cap weighted index fund. Let's just start there. And by the way, Paul, welcome back to the show, my friend.
It is great to be back, Jonathan. I really appreciate this opportunity to share with your audience because this is the exact audience that I think our work can have a major impact on. And I've got about 5 years to go in my career of teaching, and so I'm really hot and heavy right now, and hoping to reach a lot of people. So thank you. Look, this is the challenge of investing, staying the course. We ask people, do you believe in buy and hold or do you believe in market timing? Well, you know what they say. Almost everybody says, oh, I believe in buy and hold, but they don't act like that. And they don't act like that when things don't give them what they want when they want it. I mean, this is human nature, is that they really want something and they see it's been good lately. And when is the easiest time to sell anything? When it's been hot lately, because people think linearly and they think it's going to keep going.
When you see a red line, down and to the right, you start questioning everything. It's all doubt from there.
Of course. And so this is one of the reasons that it's a good idea for a lot of people to have massive diversification, not only with number of stocks, but number of asset classes. So you don't focus too much on one thing. But the reality is, if you look back to 1928, and people can say, well, what does that have to do with anything today? This is a whole different world. It is a whole different world in investing. It is much more efficient today than it was then. It's much easier to make money than it was then. But the bottom line is it's about human nature pushing prices up and down. And that doesn't necessarily always make sense, as a lot of people feel right now. So we built some charts, telltale charts, they're called. I think John Bogle came up with this term, telltale. And what it shows you is that if you look back to 1928 and you invested in the S&P 500 or the total market index, by the way, their returns are virtually the same since 1928. That it looks at the relative strength, how each one is doing, and sometimes the S&P 500 is king of the hill, and sometimes it's small cap value. But here's the reality, and this is the question for your listeners: are you willing, if the next 92 years is like the last 92 years, to be behind 72% of the time? In other words, if you looked at who's doing best, there's a lot of the time that the S&P 500 is just walloping small cap value. And there were 5 periods averaging, as by the way, as bad as 19 and a half years. Forget about the 14 years we're looking back at right now. There was a period of over 19 years that the S&P 500 did better than small cap value. That didn't mean that small cap value didn't make money, by the way. It simply means that the S&P 500 was relatively stronger. And yet, at the end of this 92-year period, the small cap value had made 24 times the amount of money the S&P 500 did. And when they came back after these long periods of underperformance, and we're seeing this right now. I can't know the future, but right now it looks like a rocket taken off here since it turned around in late 2020. But I don't know. But I know I could look at the past and see those rockets from the past, and they don't go very long, maybe 5 to 7 years. They're just outstanding performance. And then they get back in this period of reverting to the mean. But the key is the reversion to the mean is to a higher compound rate of return than when the S&P 500 reverts back to the mean. And that's the bottom line. And I got to say it every time, that's the past. There is no risk in the past. We know exactly what we should have done. Should have put all of our
I'm a
money in
genius with the
Microsoft in
benefit of hindsight.
1986.
I'll tell you exactly where
Yeah,
the top was and where the bottom was. We'll crush it.
yeah. And this industry is very good at pretending like they called them both. But I can't call them both. But I can tell you that if you're a young investor and you got time on your side, those periods that small cap value was struggling, those were opportunities to get more of it if your dollar cost averaging into that investment. But you then got to believe you're going to be there for when the rocket takes off. And I can't tell you it ever will.
Paul, I really set you up with a very adversarial question there. And I wanted to come back and say that I actually am a huge fan of exactly what you're saying. And even though admittedly, people that have been on this path, they all have had at various points. I'm sure you at some point have had doubts about, well, gosh, it's been 5 years, it's been 7 years. Our time is coming. It's been 8 years, it's been 9 years. I think it's really important to like understand the why. Like, it's not a bad thing that you're buying things on sale. And
Yeah.
it's not a bad thing that you're buying things on sale for a long period of time. You massively like you want to buy things when they're inexpensive, and we fundamentally struggle to understand this point. And I want to make sure we're making this conversation as inclusive as possible, realizing that not everybody has listened to the first episode we did. So I think we should start over with the S&P 500. What does it mean when you own a large cap fund? What does that actually mean?
Well, it means that each position, each holding in that portfolio, and how much of the portfolio it represents is based on how large that company is. So when you own the S&P 500, the first 50 of the 500 represent most of the value up or down when the market moves. But if value, by the way, those are growth companies generally. That's how they get to be really big, and certainly we understand that, and we want to be part of it. But the fact is, and this is so strange to people, is the companies historically that have been out of favor and smaller companies. It's easier for people to understand the smaller companies because they can understand those are small with lots of growth potential, and that you could make a lot of money. But an out of favor company,
Mm.
not quite as easy. But as a group, not one by one, those value companies do better, but you don't get much exposure. I love the work that J.L. Collins has done. That guy has done so much for investors. But the reality is that they are counting on the backbone of America's capitalism because that's the reality. Those big companies, those 50 or 500 big companies, that's where it's at. They represent 80, 85% of the corporate public value in our economy. But the history is different. The history is the smaller companies and the value companies produce a better rate of return because they are more risky. It's not magic. It isn't like it's an unknown thing. This has been known for decades.
Mm.
But people don't know the names of those little companies or those out of favor companies. Or why would I want to be in a dog when I could be in a darling? And so there is a emotional tug of war that goes on. And again, if we can get people, just make it part of their portfolio. If you wanted to follow somebody who believed in having all the money in the S&P 500 or the total market index, great. That should serve you very well. But if you would just put a 10% a piece in small cap value, it gives you a legitimate shot when you retire at having 20 to 30% more money, which means you're getting more money in retirement every month, or you're leaving more money to others. The portfolio is compounding and growing more because of that small slice. It doesn't have to be a lot to make a big difference.
Yeah, this is really interesting. So we kind of working through these terms for newbies here and understanding that when you own an S&P 500, when you own a large cap fund, you're owning the largest, most valuable companies in this case that are listed in the SP 500. They're American companies. They work, they do business around the world, but these are large companies that you would probably almost all of them be very, very familiar with. In fact, probably the top 20 of those companies, like, Facebook, Apple, Amazon, Google, these are the Microsoft, Netflix, there's a few more. I mean, these probably make up 20 to 30% of all the money that you have invested inside of one of these S&P 500 funds or even a VTSAX. So there's almost an illusion of diversity rather than actual diversity when you have a cap weighted index fund. This is one of my biggest kind of realizations. Now, that's great if you think that each and every year these companies can grow by 10, 20, 30, 40%. And in fact, they have the last
Yeah.
so many years. I mean, you've 10,000% returns on Netflix over the last decade. It's absolutely insane. But do you think it's going to happen again and again and again? Because as you get to be a bigger company, as you get to be more value, it is increasingly more difficult to double and triple in size. Right? I mean, it just makes sense. At some point, you hit market saturation, and that's when you start hearing companies start talking about dividends, and you say internally, "Well, they're doing dividends because they don't have any room to grow." So it's something along those lines. And it's just important to just structurally understand that. So now we've defined, large cap. Let's bring two other pieces of this puzzle. Let's define small cap and let's define value just as distinct entities for people so they can compare and contrast. What makes up a company that would fit inside of some sort of small cap index fund?
Well, let me give you a number for the large cap here that'll give you some sense of how big they are on average. And depending on the large cap index, 50 billion to 130 billion. That's the number of shares times the price in the market. That's how they are valued. If you looked at small companies, they on average will be around 2 billion. Now, in some small cap funds like Vanguard's, it's more like 3.5 billion. And some it could be 1.5 billion, but about 2 billion. So you're talking about companies. They're 1/50th the size of those giants. They aren't penny stocks. They're legitimate companies. But, and by the way, many of them will fail. Here's a number that still blows me away when I think about it, that the market has made about 10% compound rate of return if you invested in the S&P 500 or the total market index since 1928. And it turns out, according to academic research, that about One out of 25 companies, 4% of those public companies made virtually kind of all of that 10% because the other 96% made an average of 3%, about the same return as T bills.
Mm,
So, what do I want? Give me the 4 percenters. I mean, just give me a portfolio that's made up of those companies. Well, I can tell you one, a great portfolio that anybody could still do theoretically. But back in the early 70s, it was called the Nifty 50. These were the companies of the future. And people had been disappointed by market returns because they were chasing performance. And people said, no, 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 don't chase performance. Just put your money into these 50 companies and put it in the safety deposit box. Because back then we were still putting certificates in a safety deposit box. And it turned out since then, that portfolio has not only made less than large cap value or small cap value or the S&P 500, it has underperformed what you could have done without having to be smart or or seeing companies that you own disappear. I mean, literally disappear or have changed completely in what you thought they were going to be.
mm.
So, you and I think in the conversations we have with people, there's nothing wrong with large companies. They're great. There's nothing wrong with small either. By the way, to be fair, because all of us debate about, should we have all of our money in total market index or small cap value or some combination? What about just putting all of your money in fixed income? Why not have all your money in bonds? There is absolutely nothing wrong with having your money in long term government bonds. They will give you a return that is slightly over inflation, a couple of percent, maybe even 3% over inflation. But what we're doing is we're giving up thousands and millions of dollars that we would have made. Again, we're looking backwards. That's easy. But we know that $1 93 years ago has grown to $16 in T bills, 150 something in long term government bonds, and anywhere from about 7,000 to I think
Wow.
37,000 in small cap value, from the S&P 500 to small cap value. And I'm thinking the person who's counting totally on bonds is going to have to work a long time and save a lot of money. And the people that are willing to find some balance of those or be heavily into equities in the early years, they're going to be looking at. I mean, you're the fire industry. You guys are on top of
We
this.
want to do it faster and
Of
sooner.
course. Of course. And here I am working forever. I don't get paid
Well, it's
anything
not that we're going to
anymore,
stop
but
working. We just want to know we can stop working sooner. It's kind of like, I wouldn't say we're as
you're right.
far away as you think.
That's fair. I went over the edge there. I
No, it's okay. I
apologize.
just wanted to really back in because I mean, I could definitely, I think a lot of people think they want to stop working and then they stop working and they're like, well, I need something to do. And they're going to do work, but you just have sorry, we're getting off the rails. I promise we're going to give it to Paul. I think it's really important for people to hear this. You just want to spend your time doing stuff that lights you up. And Paul, clearly this conversation and this community lights you up. So you could say it's work, or you could also say this is your calling. This is why you were put on planet Earth. I want to spend more time here. Is it really work? Well, yeah, but also, yeah, we're here.
No,
So
I love it.
all right. So, okay. So, small cap, they exist. These are reputable companies. They're smaller companies. They have more room to double and triple in size. And as an aggregate, it's much more likely that they do so. Not that a single company that's a small cap will do that, but just if you own baskets and hundreds and thousands of them, again, this is not separate from index fund investing. This is just looking at the parameters of index fund investing a little bit differently. You can get the best of both worlds. Let's go to value here. And I think this is really important for people because when you say value out of favor, let me give you this character that I visualize that I think probably a lot of people do. It's a company that's out of favor. Well, what is a company that's maybe even a big company, might be a small company, probably a big company that is out of favor right now? I would say oil companies. Oil companies are struggling. Now, some people believe in the future of oil, but there are many, many people that would say, well, petrol is dying. We are
Mhm.
increasingly moving to a green future, one that does not rely on gas burning machines. And I don't know if I want to pick up big bundles that are going to be massively including these types of companies, which I believe the writing is on the wall. So I'm going to start with that because I don't think value only means dead technologies that don't know they're dead yet. Kmart, or JC Penney or whatever. Give me some other reasons
Mm.
that if we believe that companies that are out of favor are actually out of favor because the writing is on the wall, why should we still be excited about value?
I think that is the reason that value does not get the support that its history would suggest. And what happens? In fact, the academics will make this point clearly that if you're going to buy value, please do not go out there and buy them one at a time, because 5 years from now, half of them will still be out of favor and value companies. But we are talking about us sit now. This is one reason I think, and it is my personal view, and it's shared by others, that these companies, when they're out of favor, there are people who come into those companies and do things with them to make them more meaningful, more profitable, more efficient. Sometimes those people aren't thought of as being very kind because they come in and clean house, but they come in and they turn them around. And one of the great value investors from the 70s, he specialized in bankruptcy stocks and it had one of the finest track records. His name was Michael Price. Mutual Shares was the family. And that's all he did was buy those really deep, deep discounted companies. So no, people don't want them, and so they don't sell for very much. And there's opportunity. On the other hand, and you mentioned it a minute ago, the really successful companies, everybody knows who they are. Everybody wants to get on board. I've got a friend of mine who keeps on buying Tesla, and every time I see him, he says, "I'm going to buy some more."
I keep paying more for it, but load it up.
That's it. And the story he has for the future of Tesla, it just makes him so unbelievably happy because he knows he's with a great company, with a great future. And yet we know things happen to great companies with a great future. And the problem is when something happens that pops the balloon, the good story, and it becomes bad, those kind of companies can fall 25% in a day. Remember back during the when the technology bust came back in the 2000 or so, those companies would come out with the report that wasn't by missed by pennies in terms of their earnings, and the companies would within minutes be down 25% because their future changed.
I'm gonna let you keep going on that, but I want to pause you there because I think Tesla is such a great example. It's top of people's mind. There's familiarity there. We remember maybe it was several years ago where it felt like they were at the verge of bankruptcy. They didn't know if they were going to be able to keep going.
Yeah.
And
Yep.
now, like it's 400% up. You could have bought shares for maybe $100, $200 a share, something like that. And now it's selling present times when we're recording this mid-January 2021, it's selling for $800 a share. The price to earnings, which Paul, maybe you can define that term in just a second. Tesla is now turning a profit, but just barely. It has the biggest market cap, and we'll need to define terms of almost any company in the S&P. It's barely turning a profit, barely. And it's a car company, which typically, and people will, I'm going to come back to some of these points that I can already see people saying right now. It's a car company which traditionally is not a massively profitable, in terms of your cost to what you're selling about industry. Now, people will say, well, no, that's you're just fundamentally misunderstand the Tesla model. It's actually a technology company posing as a car company. I'm fine with that. I'm fine all of that. But in order for you to double your money from $800 to to double your money, it needs to be now at $1,600 a share, or they need to introduce some sort of subscription service, all of which might happen. But if you're buying it all the way up, then you need to again to double. And I think people fundamentally do not understand this point. When you buy it at $1,600 or at $16,000 a share or whatever, to double your money, it then needs to go to 32. People struggle with this with Bitcoin. They're buying it at $40,000 a coin right now. And they're like, it's nothing but upshot. Well, yeah, but now if you want to double your money in this incredibly speculative vehicle, now talking about Bitcoin, moved off Tesla, you need it to be selling for $80,000 a coin, not 45, not 51. If you want to double your money, you need it to make it to 80,000. And there's a lot of unknown certainty between here and there. And I think now that's fair to bring it back between Tesla. If everything goes right and Elon rolls out a vision that none of us are aware of, which I totally believe, by the way, could happen, it could absolutely do that. But based on their current model, which is selling a car at XY price with this amount of margin, you are paying a lot of money. And I'll give this back to you, Paul, in terms of like basic definitions, term price to earning ratio and market cap. You're paying a lot of money for the privilege of owning this relatively unprofitable company. You, you got to believe, right? You got to be a believer.
That's and it becomes a religion almost with people. And the key is to figure out, and this is what I'm trying to help people do, figure out what is the unemotional way to invest that you don't get caught by believing something that it just is not legitimately likely to happen. Doesn't mean it won't. People win lotteries, but what are the odds? What we do know, and I think this is important, is we can go back and look at the return of successful companies as a group. They're called growth, the growth index. Growth indexes last year were up, I think, 35 to 40%. And so that was a great place to be. From 1995 to 2000 or 1999, the S&P 500 compounded at over 28% a year. 5 years. And yet our expectation is 10% a year. But the expectation of investors in 2000 for the S&P 500 for the next decade was somewhere between 20 and 30% a year. That's what came out of the surveys that were taken with investors who had just seen what happened. And the bottom line is, we know, going back over 90 plus years of evidence, if you want to call it that growth has produced a lower rate of return than value by about 2% a year. Well, my book is all about an extra half of 1%. And for every extra half of 1% you can make on your portfolio over a lifetime, the accumulation, then the distribution, and then your heirs, you are going to add $1 million or more for an extra half of 1%. And now I want to know, are there more of those? If I could find more of those, it turns out there are a lot of those half percents. And when you add them all up, in some ways, they're a heck of a lot sexier than being involved in the hottest thing in the market.
Well, I don't know if they're sexier, but they're more replicable, uh, more consistent.
That's right. That's the term.
And I think that's the key here. I mean, those of us that are operating on belief, sometimes will be rewarded, but many times we will not be. And those of us that want to simplify our lives and want to increase the odds of our success without necessarily a particular belief in one company or another, without diving through it, without having all of our outcome hinging on things that are out of our control, like CEO turnover, product demand, product supply, and a million other variables that we're really not doing the research. We're just catching the news, which means the market's probably already reacted to that news. So anything that you do based on the latest news that you got is usually a dime, too little, too late. Like, can we just keep it simple and get a 0.5% here, a 0.5% there, and look for a system of those that the market is ignoring, and over time will add up $1 million each? And in your case, I think you lay out in this book, and the name of the book is We're Talking Millions. You lay out about 12 of them, I think, that will, I think, really appeal to the FI community, but I think they're universal truths. And so why don't you tell us a little bit about how this book came together and what your goal for it was?
Well, the complaints I've had about my work for years has been that it's too complex. And I'm guilty. But I'm guilty because that's what I knew in managing money for others. When I sold my company, we were managing about $1.6 billion, and we were doing all the work for these clients. So we could have 10 different funds, and we could have 3 other equity funds and 3 other fixed income funds, and we could rebalance for them and do all of those things that you kind of have to do to take care of your garden of investments. And most people don't want to do that, which is the reason they would hire firms like mine. But individuals do not want to make it that complex. And so I have been looking, what can I do to keep this dirt simple and still give people the probability of getting the kind of return that I was trying to get for my clients and have it be totally do it yourself. Because the first thing that happens, and we got to remember this, every extra half a percent, I said it earlier, every extra half a percent is an extra $1 million. I'm only talking about somebody who invests in their 20s. Let's say they start and they put away $5,000 a year and they do that for 40 years. We're not asking them to put away millions. We're asking them to put away a relatively small amount of money and then make it grow.
I want to pause on that real quick to sorry to interrupt you, but just for people to hear that
Yeah,
we are not even talking about an individual maxing out their 401k from the time they came out of college to retirement. You were talking about a very modest, can we set aside $5,000 a year? Can we
yeah.
prioritize that and focus on these small optimizations? And you're saying each one of these strategies to that scenario, not the more extreme version that so many of us are familiar with, over a 40-year investing lifetime is worth millions. Each one of these on that very modest scenario.
And by the way, I think it's important, Jonathan, that we realize this isn't just about how you add money to your return because you took more risk. It's also about how you protected your money from others having their hands on it.
Yep.
So I'll tell you one that's not even among the 12,
That's a
which could
bonus.
be it's a bonus. If you never hire a money manager like Paul Merriman, that's 2 times $1 million. And by the way, this is the payoff for learning how to do this on your own. Which, by the to be fair, that it's not difficult to do this stuff. I mean, physically, a grade school kid could do it physically. You could teach them. It's up here, in here, wherever it is. It's an emotional thing that people have to deal with. So I'm trying to figure out how could I show you that if you did this, you would have a payday eventually, and your kids and your favorite charities are going to have a huge payday because there are 12 things there that each one could add another million. And people say, you mean I could have an extra $12 million? Yes. Yes. Now, an obvious one is if you don't save, and there's that fork in the road, save versus invest. Well, that's a legitimate decision you're going to make. And what does it look like 50 years from now if you don't save? Well, that could easily be $1 million difference. But then the difference of whether you save early or wait, that's another $1 million decision if you look at the numbers. But then you come to one, Jonathan, that it's a mind blower when you think about it, because a lot of people are doing this wrong. About 25% of investors, millennials, supposedly will not put money in the stock market. And so what do we know about choosing bonds versus stocks? Well, the total market index is 10 historically, not every year, sometimes a lot more and sometimes a lot less. Bonds historically, now you can't get this now, but historically for long-term government bonds, it's been about 5, a little more than 5%. Well, wait a minute. If I put it in bonds at 5 or I put it in stocks at 10, that sounds like 10 half a percent differences. And that, if you look at all the numbers, that's where you end up. Now remember, the return you get is the real return for any investor. It's the return is not the ability to brag because you had a good year, which was probably luck in the first place. But the return is the money you take out to live on. That's real. That's not blue sky. And the money you leave to others. That's the outcome of a lifetime of investing. And so, would you be able to take more out and leave more to others, that it could be literally $10 million more than the person who puts their money into bonds, stocks versus bonds? Absolutely. And that's not magic, that's just compounding. I talk to my high school kids, and then I'll shut up here. I talk to my high school kids about inflation. I ask them, what do you think a piece of bubble gum will cost in 2,000 years? And I say, oh, but by the way, what does it cost for a piece of bubble gum today? And they'll tell me some number. It could be a dime, it could be 25 cents. And then I just go through the roof. I said, wait a minute, I only paid a penny. And so here's what's happened: you've had inflation because it's the same size piece of gum or smaller. But what if you had a 5-cent piece of bubble gum and it had inflation of 3% a year for 2,000 years? Well, I let them start guessing, and not one of them has ever hit the 2.3 trillion billion dollars it becomes. It's amazing. But that's a combination of time and a little bit of inflation. So the idea that we're all going to make 10%, that might not be the case.
Clearly, now we're moving off the track. We're moving to a science fiction novel, but clearly the entire system changes at the point at which a piece of bubble gum is costing you 2.3 trillion billion dollars.
Right. The only part that'll be the same is it'll be smaller.
Yeah, yeah. Maybe it'll last longer. Flavor will last longer.
Yeah, that's right.
This is huge, and actually, I wanted to part of what you've done in this book, and I know we have not mentioned all 12 of these, and we'll touch on a few of them at this point. I think we've named a couple. Get the book. The book's incredible. We'll give Paul a chance to share how you can get a copy of it. But what I wanted to do, aside from go through a few of these steps, is actually talk about the simplification that's occurred throughout this book, because you teased it in the end of the last episode 130 that we had you on, where we were talking about the ultimate buy and hold portfolio is a basket of index funds and actively managed funds in a couple cases that represent the entire market. And your in my understanding is you are holding equal amounts of all of these different asset classes. And we
Yes.
get the what's implied there, though, is there's actually like 12-ish funds that are being holded in a 100% equity ultimate buy and hold. And I know probably the biggest problem is for people that are doing this inside their 401k, which is where most of us start. It's where this hypothetical individual
Yep.
that's doing $5,000 a year is probably where they're investing. That
Mm.
might be harder to replicate. And so it was harder for people to implement with consistency. And I know that you have been very excited for the last year in sharing what you and Peterson developed, simplifying this massively and giving you 98. I don't know, maybe you can share with that what percentage of the benefits you think you're getting with this new version of the ultimate buy and hold.
Well, first of all, I did not develop it. Chris did, and Chris is a very very bright guy, and the idea was to keep it absolutely as simple as possible. The first step is you do use one of the 12 recommendations. You buy a target date fund. Now, I want you to keep in mind here, Jonathan, I want this to be so dirt simple that anybody could do it and they wouldn't have to manage it, but maybe a couple minutes a year. That's it.
Okay.
So they put their money in a target date fund. What happens in a target date fund? Well, as you get older, it reduces its exposure to equities and has more fixed income. They're conservative generally. They're not all alike, and you want to go get one that has index funds in it, and you want to get one that is low cost and all the things that we believe. In fact, they're in those 12 items that I'm talking about. They're all in that index fund. The problem is they don't have enough value or small cap. And then what can we do to help people get that? Well, for people who want it to be way, way simple, you could do something as simple as this: buy the target date fund, add 10% or 20%, so that when you send your check in for $100, $90 goes into the target date fund, $10 goes into the small cap value, or $20 goes into the small cap value. You don't ever have to rebalance. You just let them go. Let each do its thing. And that 10 or 20%, as I mentioned earlier, could mean you'd have 20 to 40 or 50% more in your portfolio because of that 10% slice that pays a much higher rate of return.
Mm.
And the rest of the target date fund, it's broadly diversified, US, international, mostly in large companies, which is why we add this small cap value. But for people who want to tweak it, and I think engineer type people who like numbers appreciate this. Chris said, we really want young people to take more risk in the beginning
Mhm.
and to take less. That's the whole idea of a target date fund. It helps you. In fact, you can have a target date fund, and that's the only decision you ever make as an investor until the day you die, because it will be adjusting to who you are as you age. So Chris said the problem is that we want them to have more small cap value when they're young and very little or maybe none when they're old. And so what you do is, what he came up with is you take your age, 30, you multiply it times 1.5, 45. So what happens is the 45 goes into the target date fund and the balance goes into small cap value. When you're 40, you're getting closer to retirement. 1.5 times 40 is 60. You got 60% in the target date fund. You got 40% in the small cap value. By the time you're 60, what you're going to have is 90% in the target date, conservative, 10% in small cap value. Now, we would encourage people to stop right there and leave that 10% small cap value in your portfolio. But you don't have to, because it is more risky. And but when you've lived with it, this is the interesting thing. I know lots of people my age, 77 or so, who have all of their money in equities still. And I say, are you kidding yourself? What happens if we have a meltdown? Oh, I'm not worried about that, because I've been doing this all my life and this is the way I've done it and it served me well. And look how much more money I have than you do, Paul. Okay. Because they've been all equities.
Yeah.
And they're right. I was always more conservative. And if you have done this from age 30 and done this piece with small cap value, you've lived through the underperformance and the outperformance, and you see how it works, and you understand it's not guaranteed, but it's only going to be with a relatively small slice. That relatively small slice through 30 more years of retirement is really good for the children and charities that you leave behind.
Mm.
And it makes a sizable difference. And so we're trying to make this simple. We're trying to have an investor invest without losing sleep over it. Not all will do it. So I say the target date fund. If this makes you lose sleep, you go just put your money in a target date fund and let them take care of it for the rest of your life. And I think, by the way, you'll be just fine.
All right. Well, let's spend some time on target date funds just for a second. So there's a couple things coming to mind. One is we already mentioned not all target date funds are created equal, and you mentioned we want to look for one that's low cost that contains index funds, maybe something like a total stock market index fund or S&P 500 fund, something like that. The other thing I wanted to point out, I had 3 or 4 bullet points here because I've always been a little bit more skeptical of target date funds because I kind of want a little bit more control. I don't want, as someone now in my mid 30s, but even at a younger age in my late 20s, I didn't want any exposure to bonds. You just basically said for someone that doesn't mind taking a little more risk and is still earning income, I didn't want to lock in less performance. I have no interest in bonds. And when that 28-year-old selects a target date fund, they are almost without fail going to have some percentage of their contributions going into bonds. And maybe that makes sense for a 40-year-old or 50-year-old, someone that is coming a little bit closer to their estimated retirement point. But what are your thoughts on that for this 20-year-old that you just that is listening to this and is trying to decide, target date funds? I'm not sure.
Well, and I can tell them how to solve that problem if they're interested, but I totally agree with you. I hate having bonds in the portfolio of a 20-year-old or a 30-year-old. 40 is okay, but I can tell you that I know what's going to happen. We're talking about a 0.5% For every half a percent, every 10% you have in bonds, the odds are your return is going to go down by a half a percent a year. And why should we penalize people for that 10%, which does nothing? I had the honor of being with John Bogle for an hour and a half in 2017. And I asked him, why would you do that to a young investor? And the answer is because it's not about trying to protect them from a bear market. Because how much good does 10% in bonds do when the other 90% is down 50%? So it's not because it's going to protect against the downside. It is to get them used to this as part of the total long term lifetime package, and that is there to be defensive, and it's okay to be a little defensive. I say no, it's not okay to be a little defensive, but we have to figure out how to work with it. Well, here's what you can do. When you add equities to the portfolio, let's say that you trust Vanguard, a lot of people do, and both Vanguard and Fidelity in their index based target date funds are 10% in bonds. So what you can do, little homework here, you can add equities to the portfolio, and to the extent that you add equities to the portfolio, so you have a second fund now, it's going to reduce your exposure to that particular asset class that's hurting you, holding you back rather than helping you get ahead. We kind of feel like we have to live with that, but at least we're recommending 60 for a 20-year-old. We're 70% small cap value and 30% in the target date
Mhm.
fund. So we're bringing that impact of the bond down considerably.
Okay.
Or there's another answer.
Yeah, go for it.
Build your own target date fund.
There.
That is easy to do. And you can use our small cap value strategy with it. And not only at Vanguard will you get rid of the bonds, but you will pay a lower expense ratio for those same funds outside of the target date fund.
Love it.
So,
There we go. And that a little bit more homework there. And I understand, we're talking about how can we go from really complex down to as simple as possible. And then some individuals, some of you are saying, well, that I would like an extra degree of nuance for my situation. And you say, all right, well, here would be the next version. And that is probably a little bit closer to the direction that I personally would go with. I want to mention a couple other things though. So this is really important. When someone is picking out a target date fund, the way target date funds work is they have years attached to them. The Vanguard Target Date Fund 2025, the 2030, the 2035, the 40, the 50, and you picking which year has a lot to do. You gave the math equation, but I wanted to point out to people that the year indicates how conservative versus aggressive it is. And what they mean by that, underlying that, is what exposure to bonds you have. So if you pick you pick a 2025 fund, is going to be much more conservative, and you can read that as it's going to have a much higher exposure to bonds and less exposure to equity than its 2055 counterpart. Paul just gave you an equation to kind of pick that out, but one tiny little nuance here to me, Paul, was that some people don't have an age in mind for when their date is, but like a number that they want to hit. They might say, yes, well, I'm going to be 65 in such and such year, but I'm trying to hit financial independence and walk away from this job and have a little more control of my income, ahead of maybe that absolute age number. There would be some nuance in calculating your target date fund potentially around that as well, wouldn't there?
well, there would be, and Chris Pedersen is writing a new book, and that book will include how does someone in the fire community adjust to the fact that they're going to retire in 20 years at age 40 instead of retiring at age 65.
Well, enough said. We'll have Chris on the show when his book is released, and we'll get that information then.
That would be great. But here's the thing about those target date funds that I just love them. I I have found when I address students who are graduating seniors at a particular university where I support a class there on personal investing, and I go and I speak to the seniors about all of them, not just business school seniors, about what they should do financially when they go out and they start working. And at the end, after I've told them all about the different the 12 things, so they know all this stuff about low expenses and equities and all that. How many of you really want to keep that control you're talking about, Jonathan? You said you want control.
A little
Well,
bit.
the question is, how many people really want that? And it turned out in the last group I spoke with, and there were about 150 kids there. Not everybody comes out. They're all invited, but nobody, not all of them come out. You know that feeling. Uh, two, two out of 150 said, I want to do it. I want to do
I
it.
know,
You
I know.
see, most people need the target date fund. And I'm going to give you some numbers that's going to knock your socks
I'll
off,
go
I
for it.
think. Wharton did a study of 1.2 million target date fund or not investors through Vanguard. Vanguard exposed all of the records about how much people put in, where they put it in, so they could see the risk that people were taking. They looked at three groups: the people who had no target date funds, and this ran from 2003, I think, through 2013 or 15, but no target date funds, some target date funds, and some do it yourself, and then all target date funds. Now, keeping in mind that I'm rooting for an extra half of 1% wherever I can get it, those that were all in target date funds versus those that had no target date funds, it was a 2.3% difference in compound rate of return. And why? How could that be? How could these people who think they're doing the right thing underperform? Well, maybe they still are doing the right thing because they're putting all their money in cash because they trust no one.
Mm.
And cash or a money market maybe an annuity kind of a product that they don't think there's any risk in, ignoring inflation, of course. Those who were partial in target date funds and partial do it yourself were 1.7% better per year. Now, that tells me that if somebody doesn't know what the heck they're doing, or they've listened to Paul Merriman and J.L. Collins and a whole bunch of other people and said, yikes, they all sound like they make sense. I'm just going to put it in here, do something with it. The little thing they should do should be a target date fund, not anything having to do with bonds.
Mm.
If I could reach them and shake their neck a little bit, get their attention.
And if they're younger in age, kick that year of the target date fund back.
Yes, of course, you can do that. Yep.
Yeah. Okay. All right. There's a couple other things that I think are important here that we should go into. One of them is very closely tied, so we'll start there. When you have even a two fund strategy like you're describing, so we have this small cap value, potentially index fund, and then we have that paired with our target date fund, it now poses the opportunity for rebalancing as opposed to maybe a one fund portfolio. And I'd love for you to talk about why rebalancing is important, why it's a part of this strategy, why it's one of the 12 steps, I believe, or why it's mentioned in the book. What are your thoughts on that? Because I'm sorry, let me just add one more thing. I know you're going to cover it. Because we just said that small cap value can run away. It can absolutely run away and get on a tear.
Yes. And we have no idea how long on the upside or the downside. That's the tough part. The rebalancing is mentioned twice in the book. It is not an extra half a percent. The rebalancing in the traditional kind of a portfolio is there because upfront, if we are a do-it-yourselfer, we are supposed to be investing based on what our need for return is and our risk tolerance. And we do a lot of work on our website to help people study the difference between different combinations of equity and fixed income and what the losses are like depending on how much of those two assets you have. So if, as you say, one part of the portfolio has been doing well, and that's the equity area, and you have huge profits there, and you're inside of an IRA or a 401k, so taxes are not a consideration, then if you had a risk tolerance of so much equity and so much fixed income, and now it's out of whack, then if you want to be true to your strategy, you need to sell the part of the winners. This is hard, and put it into some of the losers. And that's hard. Now, that does not necessarily actually increase your return. And if you want to increase your return long term, it's probably better not to rebalance. Because what happens if you have, let's say you have stocks in large cap and small cap, and you have some what they call blend, some value and some growth, and then you have value. Well, there's certain asset classes that we think are going to outperform the other because they're more risky. So the minute you start taking away the profitability of those asset classes, you take away part of the ability for that rocket to keep going. And you are really more likely to have more money if you don't rebalance. But in the two funds for life, it is built to rebalance because it isn't just about rebalancing back to your risk tolerance. It is about managing the strategy. There's two strategies. One is just to let them go, 10% or 20%, and the 80 or 90 in the other. But in the one that adjusts to your age each year or each 2 years, you could do it every 5 years. This is not important, but you're going to multiply your age by 1.5. That's going to be the amount that you're going to have in the target date fund, and the balance goes in the small cap value. Or, by the way, Jonathan, if you wanted to take less risk, you could put it in large cap value. Or if you wanted to take more risk, you could put it in US small cap value and emerging markets. I mean, there are things you can do to fine tune, but those people who like to fine tune, they always are looking, and so that I know they'll get there on their own. I don't have to lead them.
Okay. I'm sure we're gonna have many other questions, and I can't wait to continue this conversation with you. But I do have one more kind of curveball to throw at you. In that you mentioned the original complexity of your original ultimate buy and hold portfolio. And it strikes me that now in 2020 and beyond, technology has come to our aid and taken things that were incredibly complex and actually made them relatively simple. And I'm talking specifically about platforms like M1 Finance. I know that your pies that you originally set up for all of the different ultimate buy and hold portfolios that you talked about, you have listed on your website. I personally modeled one of those and copied one of them over. It was just a couple button clicks, and I was able to add the one of your equity pies to part of my portfolio in my taxable account, so that this does not work for your 401ks. I think it does work for a Roth IRA if you're self-custodying it, but it would not work for a 401k. But for your taxable brokerage accounts, for sure. And I mean, we're talking, you did all this work, you did all the math, it's all there. You have these different bundles for 100% equity, for 70/30, for 80, all these different types of things. And then you just click copy the pie, and the pie is right there. It's brought in M1, and then you just fund it to whatever degree you wanted to. And I'm just curious, yes, clearly inside your 401k, and clearly for people that crave simplicity, this fund, it's seal in the deal. It makes complete sense. But outside of that, if we can get all of the complexity that you loved and you've loved for 20 years,
Yeah,
and we can do it with a
yeah,
button click, and then we can just track it in M1. All we do is, I mean, it's taking care of everything. We just fund the darn thing, and we just keep funding it. Uh, I mean, is
I
that
love it.
love it? Yeah.
I do. I just think it's a. I tell young people that investing has never been easier. It's never been more efficient. Even if the market does not produce the kind of return in the future as it has in the past, the fact that we get all of this stuff so efficiently means we could probably make the same return even if the market wasn't there, because it cost so much to do this stuff before, or it was too complex. No, I love M1, and I'm sure that other people are going to do that. I don't understand why Vanguard wouldn't do that, because it allows people to automatically be able to rebalance. There's commission free, doesn't cost you anything for the trades. I mean, I just think it's marvelous. Now, I will tell you that that portfolio that you have right now is in a couple of days will be totally out of date. I'm sorry to say that to you, but we're coming out soon with our whole new recommendations for best in class ETFs. So
Oh,
if you have listeners who are into ETFs, this again, it is not the work of Paul Merriman. It is the work of Chris Pedersen. I will tell you something that will probably surprise some of your listeners. I have been in the financial community virtually all of my life. I did not get an MBA. What I'm about to tell you would not have been possible if I got an MBA. I have never done an Excel spreadsheet in my life. Now that's unusual
That is very
today. How many
unusual.
people?
I
Right.
don't.
I've always had people who did it for me. I mean, I know what an Excel spreadsheet is, but I've had some amazingly smart people and I mean and well seasoned people work with me over the years. And Chris is great, and Daryl Balls, who's the other engineer that we have that works with us. These guys donate their time. They're volunteering hundreds of hours a year to helping people. None of us make a penny in this work that we do, but Chris is the one who has taken the time to analyze hundreds and hundreds of ETFs to try to figure out which are the best. And here's the good news. Talk about the future being better. I personally have all of my buy and hold funds in DFA, dimensional funds. And right now, there's an organization called Avantis. The Avantis funds, ETFs, will be in a couple of days up on our site as recommendations, which I hope that you'll make the change in your portfolio. Avantis was set up by people who came out of DFA. They know all that research that DFA has used for all these years. And now even DFA is coming out with ETFs. And so, as your listeners may not know this, but DFA, you have not been able to buy DFA funds unless you went through an advisor and paid them something. But now anybody will be able to buy the DFA work either through DFA or Avantis. And our job, my goal, is to try to get that information to as many young people as I possibly can.
And so what Paul is saying, if the penny hasn't dropped yet, is that you could not get the purest version of what he wanted to share with people unless you went through a person that charged commissions. And now, if it's an ETF, you can get any ETF on the M1 platform, and M1 is a commission-free platform. We have a pretty cool article talking about how it actually works. For more information on that, go to chooseify.com/M1. Paul, man, this has been awesome. We've taken up a bunch of your time, but I know this is fun for you as well. And I'm sure we could, if people have questions, I'm sure we could put together some sort of roundtable. But I know a lot of people want to both get your book, they want to share it with a friend, a family member. It's a fantastic read. It's an easy read, and it'll be worth literally millions for you if you execute on it. Paul, what is the name of the book, and what is the easiest way for someone to get a copy?
It is We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. For teachers and students, it is free. What they need to do is to email me, paul@paulmerriman.com, and I will send them a PDF. I am this year starting to teach high school classes and universities, colleges classes to try to get this out to young people. And so, by the way, your foundation reaches a lot of teachers. And God, it'd be great, Jonathan, if it'd be possible to get that offer out to them, because we're not trying to sell them anything. They'll just get the PDF and that's it.
Awesome.
Otherwise, you go to Amazon. If you're so poor you can't afford the $14.95, paul@paulmerriman.com, and I will send you a PDF. And my goal, and the reason I love those PDFs, is those people can turn around and send that PDF to 1,000 people. And that's what I want. I just want this information to get in the hands of investors.
Awesome. All right, Paul. People are listening to this. They want to connect with you. They want to find out more about your work and your podcast. How should they do that?
It's paulmerriman.com. That's the website address. And this whole thing is run by the Merriman Financial Education Foundation. And we do have a few people who actually are paid to do what they do, because because there's a lot of stuff to get done. I am surprised how much stuff there is to get done, and not everybody wants to work for nothing. But
Well, somebody's got to fill out those Excel spreadsheets.
that's right. That's right. Oh no, those people are doing it for nothing. No, they're amazing. They're old. They're not as old as I am, but they're getting there.
I love it. I love it. Paul, thank you so much for coming on the show, man. This is an absolute pleasure.
And mine as well. Thank you, Jonathan, and the best to both of you. Give Brad my best, please.
I'll be back in the saddle very, very soon. I'm
All
positive.
right, it's great.
All right, everyone. Super excited to get to share this conversation and this time with Paul and highlight this very, very important conversation. I absolutely believe that we have seen a concentration of wealth over the last decade in large cap growth. And I think that it's very important for us not to have some sort of this affinity for what has happened the last 10 years and think that the next 10 years are going to look exactly like this. I think a better version of reality is to look over longer periods of time and recognize that a lot of what Paul's saying is going to manifest again. And these companies that have been crushed, maybe not a single one of them, but when you're talking about large buckets over time, there's return there. There's unappreciated return. So I think this is a conversation worth diving into a little bit more, doing a little bit more research. And what I love about the way Paul approaches is the simplicity that he brought to it. It doesn't have to be scary. This book's a wonderful start. Definitely check it out and let him know what you think. The fire is spreading, my friends. We'll see you next time as we continue to go down the road less traveled.